Okay, so if you're involved in the financial markets, trading, investing, you've probably been on that quest, right? That search for the Holy Grail.
Oh, yeah. Everyone's looking for it.
That one perfect indicator, the algorithm that never fails, the system with a 100% strike rate, something that just gives you certainty.
We're almost, wired to look for the mechanics, the system.
And it makes sense why. I mean, wanting a guaranteed outcome, especially when your own money's on the line, that's just human nature.
It is. But, well, what decades of real-world, high-stakes trading experience tells us, what our sources point to, is kind of a harsh truth. Certainty. It just doesn't exist in the markets. Period.
Right.
And if you're still out there hunting for that purely technical secret answer,
yeah,
you're probably looking in the wrong place.
Which is why the sources we're digging into today are, I think, so crucial. They really push back against this obsession with just the technicals. Our goal here, our mission for this deep dive, is to unpack material that argues the real advantage, the actual holy grail you can attain, isn't on the charts or in the indicators at all.
Nope. It's, as the sources put it, quite bluntly, it's all happening between your ears.
Okay, so that has to be the core idea for our conversation today. Most traders, maybe starting out, maybe even experienced ones, they think mastering technical analysis, candlesticks, volume, support resistance, that's the main thing.
They think the mechanics are like 80% of the battle.
Yeah. But the research we're looking at, it consistently flips that completely. Technicals are just a small piece. A necessary piece, sure, but small.
A sliver, really. The sources are pretty emphatic. Successful, sustainable trading follows an 80-20 rule. But it's 80% psychology, your mindset, and only 20% mechanics.
Right. So let's frame this for you, the listener. This deep dive isn't just about finding an edge, like a statistical advantage. Many of you probably already have a decent system. This is about gaining that specialized knowledge you need to actually execute that edge consistently, under pressure, when it really counts.
Yeah, we're moving beyond just, basic definitions of fear and greed. We're talking about building the cognitive architecture you need to perform at a high level.
Okay, let's start with defining terms, just so we're all on the same page. What is an edge in trading?
Simply put, it's a statistical upper hand. It's having a system or a process that, if you run it over many, many trades, tilts the odds in your favor, reliably.
And when most traders hear edge, their minds immediately jump to
the technical stuff.
Yeah.
There's strategy. Moving averages, applying demand zones, maybe some Fibonacci levels, indicators, or just reading the price action itself.
They're focused entirely on the external system, the mechanics.
Right.
But here's the killer question, isn't it? The one that seems to separate the profitable few from the frustrated majority. If the system is solid, why do so many traders, maybe even 90% who understand the technicals, still fail? Because they forget about the operator, the person clicking the mouse. That's the missing link. You could have the most robust, back-tested, statistically perfect system imaginable. That's your 20% mechanics. But if the 80% operator, you, is riddled with fear, or paralyzed by greed, or chasing losses,
then that mathematical edge just evaporates. It's worthless in practice.
Exactly. It never translates to your actual account balance.
So maybe we should dig into that 80-20 split a bit more. Why only 20% for the technicals? For our audience who are often quite advanced, that might sound low. Why is all that hard work building a strategy potentially worth so little in the grand scheme?
Well, think about it. Most technical knowledge isn't secret anymore, is it? It's democratized.
True. Books, websites, courses, it's everywhere. Every major support level, every classic chart pattern like a head and shoulders, every popular indicator, thousands, maybe millions of traders see the same things. The knowledge is public domain. Plus, technical systems are, by their nature, reactive. They respond to what price is already done. There's very little true, lasting, proprietary advantage left in just basic technical analysis alone.
So if everyone sees the same buy signal,
the edge isn't the signal itself. The edge shifts to who executes better, who manages their risk properly when the trade goes live, who can hold through the expected noise without panicking, who protects their capital when that inevitable string of losses hits.
Okay, so it's the application.
That's the psychological differentiator. That's the 80%.
That really reframes it. The technical edge might get you in the door, but it's crowded. The psychological edge, that's unique to you. It's your personal proprietary advantage.
Precisely.
Okay, so drawing on the experience mentioned in our sources like 17 years in the markets, what's the absolute cornerstone of this psychological advantage? What does it really boil down to?
It really comes down to two things: emotional composure and accepting uncertainty. Fully accepting it.
Uncertainty. That's tough for people.
It is. The market isn't neat and tidy, it's messy. It feels random in the short term, even if it's probabilistic over the long run. You have to be okay with the fact that your next trade, or even your next 5 trades, could all be losers, even if your system historically wins 60% of the time.
If you need certainty, you're setting yourself up for failure.
Instantly, market volatility will chew you up and spit you out. The real holy grail isn't finding a system that avoids losses. It's achieving that emotional control, that composure, where you understand your trading probabilities, not predicting guaranteed outcomes.
And this need for psychological control, it doesn't stay linear, does it? It ramps up massively as your capital increases.
Oh, exponentially.
Yeah.
We're not just talking about managing risk on a small $1,000 account. When you start trading 6 figures, multiple 6 figures, whether it's your own money or you're managing funded capital,
The pressure must be immense.
it's a different universe. What felt like a minor irritation when you risked $100 can become a full-blown panic attack when $10,000 is on the line for the same trade setup.
So the sources are saying, at scale, emotional composure isn't just nice to have.
It's absolutely vital. It's fundamental to your survival. The research is very clear. Traders who crash and burn the fastest are often technically brilliant. They know the charts inside out.
Well,
But they haven't done the specialized work to handle the physiological stress of seeing large sums of money fluctuate wildly second by second.
okay, so synthesizing this first part. We need to master 2 distinct edges. They're both critical.
Yep. You need your statistical edge. That's the 20% system, the strategy, the mechanics.
And, arguably more importantly, you need your psychological edge. That's the 80% mindset, the execution, the emotional control.
And ignoring that psychological piece, focusing only on the charts, that's the #1 reason traders fail. It's not just some motivational quote, it's the practical, verifiable difference maker.
We see it in professional evaluations, right? The trader who knows all the patterns has a great theoretical system.
Blows up their account anyway. Why? Not because the strategy suddenly stopped working after decades of backtesting. No. It's because they took 2 losses in a row, lost their discipline, started revenge trading, or got scared and missed the next valid entry.
They forgot they're a human being running the system, not a robot.
Exactly. They looked at the spreadsheet P&L, but forgot about the biological reality of operating under stress.
Theory versus execution. It's everything.
Yeah.
If you can't execute the 20% because the 80% is a mess,
Reimagined.
well, the 20% doesn't matter much.
Okay, let's shift gears slightly. Let's talk about the actual battlefield where this plays out, your decisions.
Right. Because when a trader takes a big hit, a really damaging loss, the first instinct is often to blame the market, right? Oh, it was too volatile, or my system failed me.
Exactly. But the market itself isn't out to get you. It doesn't punish setups. It just reflects the consequences of actions.
Yeah.
What it really punishes are bad decisions.
And those bad decisions are almost always
Rooted in emotion. Unmanaged, unchecked emotion.
Okay, so let's get specific. The sources highlight 5 key emotional traps that consistently sabotage even smart, technically skilled traders. We need to go beyond just naming them. Let's look at the why behind each.
Sounds good. Where should we start? Maybe with the one that stops people from even getting into good trades. Fear of loss.
Yeah, that feels foundational, fear of loss. It shows up in a couple of really damaging ways, doesn't it?
Either you freeze up, you see your perfect setup, everything lines up with your plan, but you hesitate, second guess yourself, and the entry passes you by. Missed opportunity.
Or maybe worse.
You're in a trade, it goes against you, hits your predefined stop loss level.
Yeah.
But you can't bring yourself to click sell. You hold on, hoping, praying it turns around.
It feels like a cognitive bias kicking in hard.
Oh, absolutely. It ties directly into prospect theory, Kahneman and Tversky's work. Basically, research shows the psychological pain of a loss feels roughly twice as powerful as the pleasure of an equivalent gain.
So losing $1,000 feels twice as bad as gaining $1,000 feels good.
Roughly, yeah. That intense aversion
Music
to realizing the loss, making it
reimagined.
final, is why traders will let a small, planned, manageable loss turn into a massive, account-crippling disaster. All because they couldn't stomach the emotional hit of accepting the small loss when they were supposed to.
So the crucial mindset shift here is,
Accepting losses as a normal, unavoidable part of the business. They're not failures, they're operational costs. They need to be budgeted for, managed, and accepted as part of running your statistical edge. If you fear them, you're fundamentally fighting your own system.
okay, number 2, the flip side of fear, maybe. The emotion that often creeps in after you've had a few wins, greed.
Agreed. This one's tricky because it can feel like ambition, right? Like you're just trying to maximize your potential.
How does it typically manifest in trading?
The classic example is you're in a winning trade. It hits your predetermined profit target. Say you were aiming for 20% gain based on your analysis. The plan says exit here. But the price is still moving strong in your favor. And that little voice pops up. Wow, this is really flying, and maybe I can squeeze out 30%, maybe 50%.
That voice is dangerous.
Extremely. Because the moment you listen to it, you've abandoned your plan. You're no longer trading your edge. You're gambling on hope, on a feeling. Greed makes you ignore sell signals or signs of reversal.
You get fixated on the potential upside and forget the risk.
Exactly. We see it constantly. A solid 20% unrealized gain turns into a negative 10% realized loss because the trader couldn't stick to the plan and take the profit when it was offered. Discipline means taking the profit your plan allocated, not the profit your ego desires.
Okay, which leads nicely into the next trap, often fueled by that greed or a recent winning streak, overconfidence.
Right, you nail 2 or 3 trades in a row, maybe catch a big runner, and suddenly you feel invincible, like you've cracked the code.
The market whisperer.
Yeah. And that feeling is incredibly dangerous because it leads directly to deviating from your rules. Systematically. The overconfident trader starts thinking, my risk rules are too tight, or I don't really need a stop loss on this trade, I just know where it's going.
Yeah.
They start taking positions that are way too large for their account size.
Violating their own risk management.
And making impulsive entries on setups that don't actually meet their strategy criteria. It's pure ego driving the decisions, not the statistical edge.
This sounds like classic confirmation bias, doesn't it? Recent success makes you think your current, potentially flawed judgment is infallible.
It's exactly that. It's the hubris of the short-term winner. And the sources point to humility as the antidote. You have to remember the market can humble anyone, anytime.
Treat every trade as a separate event.
Yes, each trade is just one instance in a long series of probabilistic events. Yesterday's win doesn't guarantee anything about today's trade. Stay humble, stick to the plan.
Okay, next up, the one that probably causes the most impulsive clicks. Fear of missing out, FOMO.
FOMO. The siren call of the big green candle rocketing higher.
You see a stock or crypto suddenly pumping. Maybe it's up 5%, 10% in just a few minutes.
And panic sets in. You feel this intense pressure that if you don't jump in right this second, you'll miss the entire move. The opportunity will be gone forever.
It feels like scarcity, like this is the only chance.
Exactly. It's an illusion of scarcity driving desperation. So you chase it. You buy high, often right near the peak, usually when the early, smart money is starting to unload.
And the result is predictable.
You get dumped on. The price reverses sharply, and you're left holding the bag, taking a quick, painful loss. All because you panicked.
The key insight here.
Trading requires patience, not panic. Opportunities in the market are virtually infinite. There will always be another setup, another trade, another day. The cost of missing one trade is zero.
But the cost of chasing out of FOMO
is usually a guaranteed loss, plus the emotional damage that messes up your next decision. You have to train yourself to let the market come to you, to wait for your specific setup according to your plan. Don't chase.
Okay, final trap, the one that can cause a rapid downward spiral. Revenge trading.
This one is pure, raw emotion. It's triggered by taking a loss, especially a bigger one than expected, and feeling this immediate, intense need to get it back right now.
It feels personal, doesn't it? Like the market took something from you.
Exactly. It's ego. It triggers a kind of fight or flight response. You feel angry, wrong, desperate. So what do?
You throw your plan out the window.
Completely. You abandon your risk limits. You start forcing trades on garbage setups that you'd normally never touch. Maybe you double or triple your position size, trying to make back the loss in one heroic trade.
And the market's reaction to your bruised ego?
Utter indifference. The market doesn't care about your feelings or your P&L history. It rewards discipline and process. Revenge trading is the polar opposite of discipline.
So it almost guarantees more losses.
It's a recipe for disaster. It turns that initial, maybe manageable loss into a catastrophic account blowup. The pros know, after a significant loss, the smart move is often to step away. Shut down the platform, reset, review.
Not jump back in, swinging wildly.
Never. Your biggest opponent isn't the market, it's not other traders, it's your own reactive emotional impulses. Recognizing these 5 traps, fear of loss, greed, overconfidence, FOMO, and revenge trading, is absolutely the first step to building defenses against them.
Okay, so we've identified the enemies within these emotional traps. But just knowing about them isn't enough, right? The real value is in the solutions. What are the concrete, actionable strategies the sources recommend for building that mental resilience? How do we become, as you put it, mentally bulletproof?
Right, let's talk tactics. The absolute foundation, the first line of defense, is building what the sources call an emotional firewall. And that firewall is your detailed, comprehensive trading plan.
And we're talking about something much more robust than just buy here, sell there.
Oh, way more. If this plan's going to hold up when you're down 5% on a position and feeling the heat, it needs specific, non-negotiable rules built in.
Like what, specifically?
Mandatory risk parameters are key. What's your maximum risk per trade as a percentage of capital? What's the maximum number of consecutive losses you'll accept before you must stop trading for the day?
So, objective criteria that take the decision out of your hands when you're stressed.
Exactly. For instance, a rule might be, if I incur 3 consecutive losing trades, regardless of the setup quality, I shut down my platform and do not place another trade for 24 hours. Full stop.
No negotiation with yourself in the heat of the moment.
None. The plan needs to be a mechanical document. You wrote it when you were calm and rational. Your job during trading hours is simply to execute it, not to reinterpret it based on how you feel. It removes the dangerous element of in-the-moment emotional decision-making.
Okay, firewall built. What's the next layer of defense?
Continuous self-diagnosis and feedback. And the primary tool for that is high-quality journaling. But again, we need to go deeper than just logging entry price, exit price, P&L.
You need to journal the psychology, too.
Absolutely critical. You have to track your internal state alongside the trade mechanics. Before you enter the trade, what was your stress level? Were you feeling impatient, confident? During the trade, did you feel tempted to break rules? What thoughts were running through your head? After the trade, win or lose, what was the immediate emotional reaction? Relief, elation, anger.
Why is tracking all that fluff so important?
Because it reveals your patterns. You're looking for correlations. When X happens in the market, or when I feel Y, I consistently make Z mistake.
So maybe you notice every time I have a large winning trade, my next trade is usually impulsive and oversized.
Exactly. Or I tend to cut my winners short, specifically on Friday afternoons because I'm anxious about holding over the weekend. That's gold. That's actionable intelligence about your own biases.
And this leads to the mindset shift that the sources talk about. Curiosity, not judgment.
Yes. This is huge. Instead of beating yourself up after a mistake, I'm such an idiot for chasing that, you approach it like a scientist. Okay, that was interesting. Why did I feel compelled to chase that entry even though it violated my rules? What was the trigger? What can I learn from this data point?
Treating every trade, especially the losses, as feedback.
Exactly. Every loss is tuition paid for a specific lesson. Every win is confirmation of correct process. Or maybe luck, be honest.
Yeah.
Shifting from self-judgment to objective curiosity is what allows you to learn and adapt without getting emotionally derailed. Failure becomes data, not a personal indictment.
And that mindset helps cultivate the traits we see in consistently successful traders.
Definitely. Patience, strategy, adaptability. Great traders aren't frantically clicking buttons all day. They wait. They stalk their setups. They adapt if market conditions change. They don't chase noise, and they certainly don't panic, sell, or revenge trade.
Like a sniper waiting for the perfect shot.
That's a great analogy. Patience, precision, execution only when the conditions are right, ignoring everything else.
Okay, beyond the plan in the journal, the sources also really emphasize specific mind-body connection techniques, things elite athletes use. The first one is visualization.
Visualization isn't just positive thinking. It's mental rehearsal. It's proactive stress inoculation.
So not just visualizing winning trades.
Actually, more importantly, visualizing navigating the difficult scenarios perfectly. Before the market even opens, spend 5 or 10 minutes mentally walking through potential challenges.
For example,
visualize a trade immediately going against you and hitting your stop loss. See yourself calmly executing the stop order without hesitation, without anger. Visualize feeling that pull of FOMO as a market rips higher without you, and see yourself sticking to your plan, letting it go, feeling okay about it.
You're pre-programming the correct response.
Exactly. You're building the neurological pathways for disciplined action before the stressful stimulus occurs. When it happens in real time, your brain recognizes it and is more likely to follow the rehearsed script instead of panicking. It reduces the shock factor.
And the second technique mentioned is mindfulness or breath work. This sounds simple, maybe even a bit woo-woo to some traders.
It might sound simple, but its impact is purely physiological and tactical in a high-pressure environment. Think about what stress does. Triggers adrenaline, cortisol, heart rate increases, Blood flow diverts from the rational brain.
leading to tunnel vision and impulsive decisions, fight or flight.
Right. Focused, breathwork like box breathing or just taking 5 minutes of slow, deep breaths acts as a direct countermeasure. It stimulates the vagal nerve, which sends a signal to your nervous system to calm down.
It literally switches off the panic response.
It helps bring your prefrontal cortex, your rational thinking center, back online. You can use it before your trading session to start calm, or crucially after a losing trade or during a stressful period to reset yourself physiologically. It gives you back control over your internal state, which is the only thing you can truly control in the face of market uncertainty.
Okay, we've established the dominance of psychology, the 80%. But the sources suggest this mental control, or lack thereof, has another huge impact on your actual productivity and how efficiently you use your time.
Absolutely. There's a quote highlighted. Knowledge is not power. Knowledge is only potential power when and if it is organized into definite plans of action.
Meaning knowing what to do isn't enough. You have to actually do it efficiently.
Right. And this shifts the focus to ruthlessly analyzing how you're spending your trading-related time. The sources point out a massive efficiency gap for most traders. They feel like they're working hard, putting in the hours.
But the actual productive output is surprisingly low.
Exactly. The analogy used in the material is tracking calories, which I think hits home for a lot of people.
Yeah, you think you're eating, say, 2,000 calories a day. Seems reasonable. Then you meticulously track every single thing for a week.
Every bite, every drink, that handful of nuts you forgot about, the oil in the pan.
And suddenly you realize, whoa, it's actually closer to 3,500 calories. The perception versus reality is way off.
The audit of your time as a trader is exactly the same principle. You might think, I spent 3 solid hours trading today. But when you break it down honestly,
how much was actual focused execution, analysis based on your plan, and journaling?
Versus how much was scrolling through Twitter, reading conflicting news headlines, watching financial TV, getting sucked into forum arguments, staring blankly at charts, or maybe just agonizing over a past mistake.
The sources use a gym analogy too, right?
Yeah, it's a good one. You go for a 45-minute high-intensity workout, great. But that core 45 minutes often involves 30 minutes commuting each way, 15 minutes changing and prepping, maybe 30 minutes cooling down, showering, chatting.
So that effective 45 minutes actually consumed 3 hours of your day.
Right. The sources call that difference wastage that can be condensed. And if you apply that kind of inefficiency ratio to your trading day,
it's huge. Hours lost.
Catastrophic, potentially. If you're spending an hour revenge trading after a loss, 45 minutes dwelling on a missed opportunity, 30 minutes randomly browsing charts without purpose, that's time stolen directly from productive, edge-enhancing activities.
This failure to structure the day to control focus is identified as a major hidden reason why technically competent traders still fail. It's not lack of knowledge, it's poor operational discipline.
Precisely. And the cost of this inefficiency isn't just wasted time, it's the multiplier effect on your development.
Meaning?
If you waste, say, 3 to 4 hours every trading day on unproductive, emotionally driven, or simply unfocused activity, those are 3 to 4 hours you didn't spend on things that actually build your edge.
Like what? Backtesting your strategy modifications.
Exactly. Or meticulously reviewing your journal to find recurring psychological errors. Or optimizing your entry and exit criteria based on data. Or practicing those visualization and mindfulness techniques we just talked about.
Okay, so let's compare 2 traders. Trader A wastes 4 hours a day. Trader B uses those 4 hours for focused improvement.
Over a year, assuming maybe 250 trading days, Trader B has invested an extra 1,000 hours of focused, deliberate practice into their craft compared to Trader A.
Wow. The performance gap between them is going to become enormous, purely based on time discipline.
It's inevitable. Trader B isn't just trading better in the moment. They're preparing better, faster, and more effectively. They're compounding their skill advantage, while Trader A is just spinning their wheels, often reinforcing bad habits.
It really highlights the link between emotional control and productivity, doesn't it?
Absolutely. The emotionally reactive trader wastes massive amounts of time feeling bad, trying to fix things impulsively, chasing low probability setups to make up for losses. The disciplined trader acknowledges the error, logs the lesson, and immediately refocuses that saved time and energy on the next high probability opportunity or on system refinement.
The sources mention structured programs or methods helping traders accelerate this self-awareness.
Yes, significantly. One trader's feedback was that using a specific self-diagnosis framework helped them pinpoint emotional triggers in minutes. Things that had previously taken them 6 months of confused, frustrating personal reflection to even begin to understand.
So structure saves time. And time in trading is definitely capital.
It is. Self-awareness, efficiently gained, is a massive edge in itself. It lets you plug the leaks in your process much faster.
All right, let's zoom out to the long game. One of the strongest arguments in the source material is about change. It basically says, look, change isn't optional in trading. You're going to change your approach, your habits, how you handle risk, probably significantly within the next, say, 1 to 5 years.
Right. The market environment changes, you evolve, something's going to shift. The real question isn't if you'll change, but how.
And this presents a really stark choice, doesn't it? 2 distinct paths.
Very distinct. Path 1 is choosing to change.
Music licensing
being proactive.
reimagined.
This takes courage, self-awareness. It means acknowledging, okay, my mindset is holding me back, and then actively deciding to invest the time, maybe the money, into specialized psychological training or coaching.
You're taking control of your development process,
Yeah.
making a strategic investment in yourself.
Exactly. That's the proactive path. Path 2 is being forced to change, the reactive path.
What does that look like?
That's when you wait until the pain becomes unbearable.
Artlist
You ignore the
IO.
warning signs, keep making the same mistakes until you suffer such a significant financial loss, maybe blow up multiple accounts, lose investor capital, that circumstances literally force you to confront the psychological demons you've been avoiding.
That sounds incredibly painful.
The sources describe it as extremely painful and vastly more costly in every sense,
Music
financially, emotionally,
licensing
mentally.
reimagined.
When you're forced to change out of desperation, you're operating from a position of weakness, fear, and maybe even trauma. It's a much harder place to rebuild from.
Compared to proactively choosing to improve from a position of relative stability and strength.
Precisely. It's the difference between choosing to go to the gym to get stronger versus being forced into physical therapy after a serious injury caused by neglect.
And this isn't just philosophical. The sources provide some pretty compelling statistics on the impact of targeted psychological
Artlist.io.
training programs for traders.
Yeah, the data really drives the point home about mindset being the ultimate differentiator, especially in environments like proprietary trading firms where performance is closely tracked.
What did the numbers show?
One key finding was that over 80% of funded traders who seriously engaged with and completed specialized psychological
Music
training
licensing
programs
reimagined.
managed to keep their funded accounts for over 2 years. That's a huge indicator of sustainability.
And the flip side.
The traders whose accounts were lost the quickest? Overwhelmingly, they were the ones who skipped or only superficially engaged with that type of rigorous mindset training.
Wow, so it really confirms. Technical skill gets you funded, maybe, but psychological mastery is what keeps you funded and allows you to actually profit long term.
It's the key variable. The specialized training,
Artlist
according to
IO.
the sources, gives traders who embrace it a kind of unfair advantage. They're competing against peers who might be just as good technically, but who haven't fortified their minds against the inevitable pressures.
It's the formula for consistency then. If you can increase your odds of keeping capital, achieving regular withdrawals, seeing those
Music
meaningful payouts,
licensing
5 decade, $10,
reimagined.
whatever your goal is, month after month.
Then investing upfront in mastering your mind isn't an expense. It's arguably the most critical insurance policy you can buy against future blowups. It's risk management for your entire career.
And this focus on the psychological edge isn't just for individual retail traders trying to get funded, is it? It seems to permeate the highest levels of professional capital management too.
Absolutely. The sources talk about ambitions to grow a proprietary trading fund to, say, $100 million in capital allocation. And when they're looking to bring in top-tier traders,
What's the number one thing they screen for beyond a track record?
Artlist.io.
psychological resilience. They know technical strategies can be learned or refined relatively easily. But that core discipline, the ability to execute under fire, the emotional stability, that's much harder to instill if it's not already fundamentally there and actively maintained.
So they might even take a trader using a different strategy, as long as the mindset is
Music
rock solid.
licensing
Exactly.
reimagined.
They're open to traders bringing their own proven, battle-tested systems, whether it's based on discretion, algorithms, whatever, provided that trader demonstrates mastery over the 80% psychological component. It just underscores the professional reality. At scale, mindset isn't just important, it's paramount. It's the prerequisite for handling serious capital.
Once you build that mental architecture, you have the framework, the formula for responding correctly under pressure.
You position yourself statistically for the long haul,
Artlist.io.
for the kind of consistent profitability that actually makes a difference, rather than just providing short bursts of adrenaline followed by painful drawdowns.
Yeah.
Hashtag tag outro battle.
Okay, let's try to wrap this up and pull together the key takeaways from this deep dive. We started out looking for that elusive trading holy grail.
And it turns out it wasn't some secret indicator or magic algorithm after all. It was understanding and internalizing that 80-20 rule.
Right. The biggest edge you have is your own mind. And ironically, the biggest potential liability you face is also your own mind if left untrained.
You absolutely need both edges locked down. The 20% statistical edge from your system, yes. But far more critically, that 80% proprietary psychological edge, your execution, your discipline, your emotional control.
And mastering that 80% isn't a one-time fix. It's not like you read a book and you're cured.
No way. It's the daily practice. A conscious, ongoing commitment to discipline, to staying humble, and to constantly diagnosing your own performance through honest journaling and feedback.
So the ultimate goal here isn't just to scrape by, to survive the market's inevitable challenges.
It's to develop the mental fortitude to actually dominate your own process, to execute your plan flawlessly, consistently, regardless of the fear, greed, or uncertainty the market throws at you daily. That's where true, lasting success comes from.
Okay, so let's leave our listeners with a final thought to chew on, something provocative based on everything we've discussed.
How about this? The market is a relentless feedback machine. It will test you, tempt you, and give you clear, sometimes brutal feedback every single day. Now, if we accept the idea that every loss, every mistake is tuition paid for a lesson, take an honest look at your recent trading. What specific curriculum are you currently enrolled in? What lessons are you paying for over and over again? And maybe more importantly, how quickly, how deliberately are you actually applying those costly lessons to ensure you don't have to repeat that same expensive course next week, next month, next year?
That commitment to learning and changing based on the feedback, that's the real path forward.